If you look at bank advertisements right now, 2026 is the year of free travel. But look at the reality inside the terminals. We are seeing record-breaking crowds, widespread cancellations, and massive delays. This split-screen chart illustrates the squeeze. On the left, baseline travel costs are trending up. On the right, the average annual fee for a premium credit card is climbing right alongside them, with some cards now charging nearly $800 a year. Banks know travelers are desperate for relief, so they offer massive welcome bonuses, sometimes up to 175,000 points, to distract from the recurring costs. Consumers are taking the bait, picking cards based entirely on the sign-up bonus without checking if the card actually fits how they live. Warning tone: if you pay a $795 annual fee for a premium card, but your schedule only allows for one family vacation a year, you are operating at a severe net loss. The bank is keeping your money, and you are quietly subsidizing the rewards for frequent flyers. A massive sign-up bonus can offset a high fee for the first year, but long-term profitability requires a sustainable fit. For a card to remain an asset after that first year, its recurring costs must align with how often you actually step onto an airplane. To measure that alignment, you need to calculate your effective annual cost. This is the only metric that matters when evaluating the crowded card market. The calculation is straightforward. You take the upfront annual fee and you subtract the exact cash value of the perks you realistically use. If a card charges $795, but you consistently consume $400 in travel credits, your effective cost is $395. To drive that effective cost down to zero, we use the scenario match framework. This grid plots the entire global credit card market on two simple axes: how often you travel on the bottom and how willing you are to optimize your spending on the side. When you plot the data, the market cleanly divides into three distinct operational tiers: the zero-fee utility card, the mid-tier optimizer, and the premium heavyweight. Identifying your exact coordinate on this matrix guarantees you stop paying the bank for luxury perks you never actually use. Let's start in the bottom left corner with the Utility Shield. This tier is designed specifically for the occasional traveler or the budget-conscious international shopper. The strategy here is highly targeted. You acquire a specialized credit card with absolutely no annual fee, and you use it exclusively for overseas travel or foreign currency purchases online. This pie chart illustrates a standard $100 overseas purchase. Basic cards silently add a foreign transaction fee, a 3% penalty on everything. Utility cards eliminate this. By absorbing that slice back, you generate immediate savings on every overseas transaction. But the trade-offs are steep. Because you pay no fee, you forfeit all luxury perks. You get no airport lounge access, no primary rental car insurance, and minimal reward points. The Utility Shield is a pure defensive play. It saves you money on the ground, but it offers zero logistical protection when your flight is canceled or your bags go missing. Moving to the center of the matrix, we find the mid-tier optimizer. This tier is engineered for the regular traveler, taking 1 to 3 trips a year. The buy-in requires accepting a moderate annual fee, usually around $95 US. In exchange, you enable higher point multipliers on your daily spending. This tier relies on aggressive point multipliers. Instead of a flat 1% cash back, you earn 3 or 4 times the points on daily domestic expenses, like dining and groceries, rapidly turning your normal budget into future travel currency. To get outsized value from those multipliers, you have to use transfer partners. A transfer partner is an airline or hotel loyalty program that allows you to move your credit card points directly into their booking system, usually at a 1-to-1 ratio. This graphic shows the advantage of transfer partners. Redeeming 60,000 points through a bank portal yields $600 in cash back. But if you transfer those exact points directly to an airline for an international flight, they can easily double their value. The trade-off here is your time. Capturing that value requires you to learn complex airline award pricing charts and navigate clunky loyalty portals to find available seats. The mid-tier sits at the financial sweet spot. It can heavily subsidize your annual vacations, provided you are willing to learn exactly how the point system works. Finally, at the top right of the matrix is the premium heavyweight tier. This is strictly reserved for frequent flyers taking 4 or more trips annually. Accessing this tier requires a massive upfront financial commitment, with annual fees ranging from $400 to well over $800. In return, you receive comprehensive friction shields. You bypass crowded terminals with unlimited global lounge access, you get elite hotel status for room upgrades, and the card pays for your expedited security clearance. But these cards come with a hidden catch, known as coupon book fatigue. Coupon book fatigue is the mental exhaustion that sets in when you have to track and spend dozens of fragmented, temporary statement credits every month just to recover your fee. Banks mathematically offset that massive $795 fee by drip-feeding your money back to you. They offer a $10 monthly rideshare credit here, a $20 dining credit there, and a specific airline incidental credit. You have to stack them perfectly to break even. If you forget to use those specific microcredits before the month ends, they expire. The math breaks down, and you take a severe financial loss. Holding a premium card is essentially a part-time job. It only generates a profit if your organic lifestyle already perfectly aligns with a card's complex ecosystem of credits. Now that you understand the tiers, we can map your exact behavior to the correct card using a strict logical progression. This animated flowchart starts with one critical question. Do you travel internationally 3 or more times a year? If the answer is no, you immediately eliminate all premium cards. You route directly to the mid-tier optimizer or the zero-fee utility shield. If the answer is yes, you face the second node. Are you willing to track monthly statement credits to offset high fees? If you refuse to track credits, you route to simple, flat-rate premium cards that offer travel credits in one annual lump sum. If you agree to track them, the premium heavyweight tier becomes mathematically viable. Rigorously following this logic tree ensures you stay in your lane, which is the only way to guarantee your effective annual fee remains at or below zero. There is one final dangerous temptation in the credit card market: chasing the highest welcome bonus regardless of actual behavioral fit. Doing this often leads to manufactured spending. Manufactured spending is the risky practice of forcing yourself to buy things you don't actually need just to hit a card's minimum spend requirement before the deadline. The logic is simple. If you have to spend money you wouldn't normally spend just to justify a card's existence, you are losing the game. The banking system is mathematically designed to profit off aspirational travelers who overestimate their future vacations and spend outside their normal habits to earn points. To win, you have to master your own behavioral data first. Pick the tier that matches your reality and force the credit card to work for you.